What a wild day on Wall Street. For a minute there, it felt like there was a glimmer of hope, but by the closing bell, any optimism had pretty much vanished. The market was pointing decisively down.
So, if you just glanced at the Dow, you'd see it was down about 84 points, or 0.18%. But honestly, that single number, it doesn't even begin to tell the whole story of what was going on today. Because the weakness was so much more widespread than that. You look at the S&P 500, which gives us a much broader view of the market, it fell more, about 0.37%. This shows the negative feeling was hitting a much bigger group of stocks.
And then you get to the tech-heavy NASDAQ. Oof, it took the biggest hit of the day, sliding a really significant 0.84%. So yeah, a tough day all around, but it was especially painful for tech investors.
So what in the world was going on? What was spooking investors so badly? Well, it wasn't just one thing. It was this powerful and frankly pretty unusual combination of two totally different headwinds. Let's break them down. So the first headwind is a classic one, something we've seen before: geopolitical conflict and how it ripples through the economy. The whole situation with Iran was front and center, creating this fog of uncertainty that markets absolutely hate.
And here's where things get really confusing for investors. On one hand, you're hearing these whispers of back-channel diplomacy, which gives the market a little bit of hope. But then, on the other hand, you have the very real, very concrete deployment of thousands of U.S. troops. These signals are polar opposites, and it makes it impossible for anyone to get a clear read on what's coming next.
You could see the immediate economic impact. With all this uncertainty swirling around the Middle East, what did oil prices do? They surged. Both Brent and NYMEX crude were up over 4.5%. That's a direct hit to the wallets of everyday people and businesses, and it just pours fuel on those inflation fears.
We also got our first real piece of economic data that captures what's happening, and it came from the S&P Global PMI report. And the picture it paints is, well, it's pretty concerning. We're seeing business activity slowing down, prices are spiking, consumer demand looks softer, and some companies are already starting to cut jobs to save money.
And here's the kicker. The report points out that this isn't just about costs going up for businesses. No, they are now passing those higher costs on to us, their customers. This has led to, and I'm quoting here, the largest increase in average selling prices since August 2022. That is real inflationary pressure building up in the system.
So, okay, geopolitical tension and inflation, that was clearly a huge factor today. But that doesn't fully explain why tech stocks got hit so hard. There was a second, more modern headwind brewing, one that mixes brand new technology with some good old-fashioned financial jitters.
And that brings us to headwind number 2, this really volatile mix of instability in the massive private credit market, combined with some truly disruptive news coming out of the world of artificial intelligence.
Okay, first, let's talk about private credit. If you're not familiar, think of it as this enormous, multi-trillion-dollar lending market that operates outside of the regular banks. It's been booming for years, funding everything from small businesses to huge corporate buyouts. But now we're starting to see some serious signs of stress.
And this is a major, major red flag. When you see giants like Apollo, BlackRock, and Morgan Stanley all start limiting how much money investors can pull out of their funds, it tells you that people are getting nervous and rushing for the exits. These firms are basically pumping the brakes to prevent a full-blown run on a really critical part of our financial system. So at the exact same time all these credit fears were bubbling up, that sell-off in software stocks, it just reignited. And the reason why is this renewed fear that a brand new type of AI could make a whole lot of existing software, well, completely obsolete. The technology at the heart of all this anxiety is something called an AI agent. And you got to think of this not just as an AI you talk to, like a chatbot, but as an AI that can actually do things for you. It can autonomously navigate different apps and complete complex tasks all by itself. And look, this is not science fiction anymore. The AI startup Anthropic just launched a new agent that shows off these incredible abilities. It can control a computer, it can be operated from a phone, and here's the scary part for software companies, it's starting to handle the exact kinds of office, financial, and management tasks that their products are built for. This poses a direct existential threat to their entire business model. So let's recap. You've got war, inflation, credit worries, and AI disruption all hitting the market at the same time. It is a lot to process. But amid all this short-term chaos, what does the path forward even look like? Well, a key point of debate right now is what the Federal Reserve is going to do about interest rates.
The market has completely flipped its expectations. Before all this, it was pricing in cuts. Now, no cuts. In fact, it sees a 17% chance of a hike. But there's a really strong contrarian view that says this is a huge mistake.
And that view comes from Citrony Research. They argue the Fed is not going to panic over an oil price shock. Their point is that today's situation is completely different from what we saw back in 2022. Rates are already high, and the Fed knows that hiking them even higher won't magically create more oil. They believe the Fed will look through this temporary inflation and still cut rates within the next year.
And while the whole market is busy debating the Fed, you've got these major corporations making enormous bets on the future. A top Korean tech company, SK Hynix, is planning a big U.S. listing. Meta just set a frankly wild $9 trillion valuation target, and that mega IPO from SpaceX could be just around the corner. These are not the moves of companies that are pessimistic about the long-term health of the U.S. market.
So what we have right now is a market that's being pulled in two completely different directions. The short-term picture is dominated by fear and uncertainty, and that's driving all this wild daily volatility. But if you can look past the immediate noise, you see these powerful signals of long-term optimism and some serious underlying strength.
This leaves us all caught in this incredible tug of war, right? Between the conflicts of the past and the disruptive technologies of the future. So the challenge for any investor, and I think the real opportunity, is figuring out how to navigate the turbulence of today to get ready for the promise of tomorrow.